All right, so we are recording. We have a meeting. People can hear me and see my screen. Everything is hunky-dory. Take it away, Mr. Computer.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, CSW, nor its affiliates, nor any of the respective offices. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, and registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction.
You are now muted.
Visit the SEC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services determined to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on the specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Okay. So it's going to be a really fun webinar. Let's see. You might get to see a grown man cry if the Russell keeps going up. Look at that. We are looking at a $14,000 loss at the moment and $11,000 of it today. Yesterday, we had this lovely dip, and we managed to get back to almost even, but I left 10 contracts short, and that was not helpful because we started going up and up and up again, but I was hoping 1350 would fail. It didn't. We went up, and the only thing I could do is add 10 more. I mean, that's, if you're going to play with conviction, you got to play with conviction. So I added 10 more contracts, causing a massive loss at this point. But at least I got my basis up to 1345, which, if you asked me a week ago if I would be happy with 1345 as a short position on the Russell with 20 contracts, I would have been like, oh my God, yes. But it's not looking good right now, is it? Where are we? Today. Okay, so in today's post, I mean, this is really painful stuff at the moment. I pointed this out this morning because we had the Russell chart. Last time we started shorting the Russell when we thought it was getting toppy, and we had a very bad time. I think we started around 1340. Or maybe even lower, maybe 1330, I don't know, somewhere around here anyway. So we did the same thing. We were shorting and shorting and kept going up and up and up. It did the same move. See this move? Thing down, big down, then up, then it looks like it might go down, then it goes back up, and then it goes ridiculously high. But on this date, on November 25th, I called it in the, this is the morning, November 25th. The day before, we kept shorting along the way, and I kept advocating it, and people kept freaking out that we kept going up, and I said it can't keep going up forever, and it seemed to. But then we got this wonderful, wonderful run down, which, we broke even around here at 1335, 1340, and from here down is all gravy. I don't know. I mean, maybe we should just wait for the first leg down and then play further down. I don't know. It's hard to say because this was this morning, 1350. We're at 1360. I mean, we're at 1360 now. This is just frickin' nuts. But not really different than this pattern. Okay? Got this little curvy thing here. We went up, big down, then up, then a little down, then a big move up. Today's a big move up. And if you're lucky enough to catch that, you get a huge run down. Now, if I'm lucky enough to get 20 contracts, and obviously I would scale out though, but if we got 20 contracts and move 35 points down, which is only 25 now, that would only take us to here, 35 points down. If we get 35 points down with 30 contracts, that's $70,000. So, when you're playing the future, it's a risk-reward thing, but you can't play and lose $15,000 if you can't afford it. It's like, I'm planning to make $70,000, but I can afford to lose the 15, 20, 25 that I'm going to lose if this thing blows up in my face. Let's say again, if it continues to blow up in my face, it's certainly blowing up in my face right now. Look, Jesus. And there's certainly no help from the S&P, which is flying. Now, what was the all-time high on the S&P? Let's ask that question. The S&P at some point came up around this high. What was he? No, it never. I thought it did. All right, I'm wrong. I thought we hit 2,200 at some point. This is it. This is a new, every inch we move up now is a new high. So, so really crazy stuff. So that's a bad thing because when the Russell pulled back a couple of weeks ago, the S&P was lower. It topped out. I was thinking we hit 2,200, but the S&P topped out at 2010 or whatever it was, or I'm sorry, 2210. So it topped out around 2210 and spiked up to 2214. But let's call it 2210, other than a silly spike. Then it fell down. But now the S&P is quite a bit higher. It's 10 points higher almost. And the Russell, why would the Russell not be 10 points higher? If the S&P can make 10 points, so can the Russell. They're both priced in that range. So the more this guy climbs, and this isn't supposed to happen. This is two standard deviations. We're like the third standard deviation off of what would be expected statistically. This is ridiculous, and we're going to hit 25 right now. Maybe not. So I wouldn't play. I am playing, but I wouldn't play. As a general advice is don't do this because it's freaking crazy. And that's a shame because I'll be telling you how happy I am I stuck with this trade if it goes the other way. But at the moment, I'm freaking not happy at all. I can't believe how badly this thing is going and how it just relentlessly keeps climbing. And I certainly didn't see any news that would have made it go up, but it was essentially it's been it's been all morning. It's been since we opened, basically. But we really took off when Europe closed at 11:30. Then all of a sudden, all the buying flipped here. And, whether it's the flow of funds, which we talked about in the Morning Post, or whether it's money coming out of Europe, it can't be money coming out of Europe because Europe had a better day than we were even dreaming of. Europe's day, where's that? Look at Europe's day. Look at the Euro stocks. 1.35%. The DAX is up 2% in a day. It's like a freaking penny stock. It's the entire country's index up 2% in a day. They're testing the 11,000 line. We haven't seen DAX level. Let's see. When have we seen DAX 11,000? Look at this. That's 500 points. That's a 5% move in 3 days. Yeah. Look at that. The last time we were this high on the DAX, we had a massive crash. But we were higher. We were almost 11.5. Do we have a longer view? We do have a longer view. Okay, so it's hard to see what's going on here, but here we are. So that was here, and we had come down to about where we were down here. We went up very sharply, came up to 11.5, and then completely collapsed back to 9,000. That's a horrifying market. So since then, we've been much less volatile than we were in 2015. 2015 was insane. We went from 10 to 12, 20% up, 20% back down, 15% back up, and not quite the same year, but then 20% down from there. That's freaking crazy. This is a national index. No wonder the Germans are pissed. Wow, I'd be pissed. How do you invest in this market? 20% up, 20% down, 15% up, 20% down. So we could have taken a vacation here and then come back here. So we could have taken it's 2014, a 2.5-year vacation. You should have just skipped this entire bullshit. Oh my God. This is such a stupid job, I gotta tell you. Watching a meaningless index bounce up and down. Alright, so. Somebody sell something, yeah, right? No, my theory is any little piece of bad news will send the market tumbling, but I guess not. What's the? Ow, jeez. Oh, that's the Dow. My other chart has the Dow. Let me make this one look like that one. I'll tell you what I saw. I thought it was the S&P because we were just looking at the S&P in that position. See, I thought that was the S&P. I was like, shoot me now. Look at this. These don't usually break. That's freaking crazy. The second resistance line does not usually collapse like that. So that's the Dow. This is coffee. I'm losing. I got a nice loss on coffee too. Coffee contracts are expensive. It's only 4 contracts down $11,000, but they're for July, so I'm pretty stuck on that premise. But that's wow. So wait, who's crazy, the Dow or the S&P? Clearly the Dow is crazier at the moment. Almost 19.4. How do you not short this? 19.4, 13.60, 22.25. It's just screaming to be shorted. That's the Nikkei. We don't care about them right now. The NASDAQ. Oh man, 48.20. But when you look at it, you say, look, the NASDAQ is asleep. It's lagging. Why is it not up at 48.50 by now? What will be stopping it? It's only lines on a piece of paper. It doesn't mean anything. Ugh, crazy. I literally can't even believe what's happening right now. And then not because I'm short and losing money. I've lost money before. That's not the issue. It's a question of like, this is just an insane market. I haven't seen this since, going on the downside since 2008, and on the upside, really, it was like 1999. I mean, just cannot believe people would buy a stock at these values. But as we talked about this morning, money is coming in. The money is coming in through index funds. And the index funds don't look at the value of a stock. They just have a bunch of stocks in their index, and let's take a look. If we look at SPY top holdings. To tell you the percent, yeah. So Apple is 3% of SPY. Microsoft's 2.5%. So when you buy SPY, when you say, oh, in my 401k or IRA, I'm going to buy SPY. So, and by the way, everybody is buying more of these things because if you have these index funds in your IRA and 401k and you got a raise, then probably you're putting more money into these stocks. So that's happening too. So Mobil, Johnson & Johnson, Berkshire Hathaway, Berkshire Hathaway is SPY, so it's an interesting point to put in. JP Morgan, Amazon, GE, these are your top holdings. Below this, you quickly go below 1%. If you think about it, there's 500 things in the SPY. UNH, Coca-Cola, Home Depot. So you can't stop it. You don't have to like it. But this is what they're buying, and this is the actual proportions they're buying them in. So every dollar that goes into SPY gets split up like this. So the worst companies, I guess can't do the bottom 25, can you? Oh, yeah, you can. Look at that. You're buying Zodis. You're buying Zions Bank Corp. You're buying Zimmer, you're buying Yum, you're buying Yahoo, you're buying Yahoo Sucker, you're buying Xylem, you're buying Xilinx, you're buying Xerox. This is the bottom of the SPY. Wyndham, Willis Towers, Williams Companies, Whole Foods. Why is Whole Foods so tiny? That's interesting. Well, that's alphabetical. I just realized that's not even, this isn't the amounts, but they happen to be. But when you look at just the average holdings, these average holdings, that's the normal amount, 0.1%, that. So when you talk about the top 25, oh, stop doing that. Oh, now I can get the top 25? Are you kidding me? Now I'm stuck alphabetical. Let's see if we can reboot it. There we go. Oh, I see. Yeah, okay. There you go. There's the bottom of the barrel. Legg Mason, Owen, Illinois, News Corp, First Solar. I don't know why News Corp is so little, actually. It's interesting. First Solar, Urban, Pitney Bowes. These are the bottom as far as weighting. Under Armour, News Corp again. Oh, they got another News Corp. Tega, H&R Block. They're good this time of year. Actually, H&R Block is an interesting one to buy this time of year. TripAdvisor. So, you don't have a choice. You're buying all of this stuff. And obviously, you look at how negligible the amounts are on the bottom compared to the top. It's so disproportional. You got 3, 5.5, 7.5, 8, 9.5, 10.5, 11, 12, half, 13. And a half, 14, 15 and a half, 16 and a half, 17, 18, 19, 20, 21, 22, 23, let's call that 24, 25, 26, 27, 28, 29, 30. Okay, so 30% of the S&P is 1, 2, 3, 4, 5. Well, 25, duh. So 1/3 of the S&P is 25 companies. That's 1/3 of the SPY. So basically, now that's the interesting thing when we talk about manipulation, right? If you know this, and you're a hedge fund, and you want people to take Under Armour and Urban Outfitters and H&R Block and Murphy Oil off your hands, right? You get more bang for the buck, not by telling people to buy this, and not by telling people you like this thing, but you go on TV and you say, we think ExxonMobil is a buy. We're putting a buy on Apple and Microsoft and this and that, because when they go up, it forces people to buy all the crap. I'm not saying they're all crap. I'm just saying, whatever crap you have and you're stuck with it. If you have small cap stocks in the S&P or small weighted stocks in the S&P, if you can get people, if you do an upgrade now, Goldman Sachs is fantastic at this because what Goldman Sachs does is they'll upgrade a sector, like they'll upgrade the banking sector, or they'll upgrade tech, and they'll say, oh yeah, we think Google, here's a Google twice. This is nice. Google's in twice, so they're really 2.5%. But all they have to do is say, we like Google, Facebook, or Jim Cramer, of course, is always saying this, right? Bang, right? Facebook, Amazon, Netflix. I don't know if Netflix is on here, but Facebook, Amazon, Netflix, and Google, right? So Jim Cramer goes on TV, and he says bang, and the Goldman guys say, oh yeah, buy those stocks, those are great, whatever. And all they have to do is do an upgrade like that, and the whole S&P is going to go flying higher. And it takes all the crap with it. In the Dow, the Dow is even more sensitive, because if you look at the DIA, there's only 30 components. And here you have Goldman Sachs, which has been now, Goldman Sachs has been the biggest mover on the Dow, and it's 8% of the portfolio. So it took everybody else with them. Now, what is this showing me? Performance, DIA, portfolio weight, I don't know. Okay, year-to-date returns. That's not really helpful. Okay. Well, okay, yeah. Goldman Sachs up 30% for the year and 8% of the Dow. So 8% of the portfolio went up 30%. 30% of 8% is 2%. So 2% of the entire move in the Dow is from this one company. But what happens? When Goldman Sachs goes up 30%, and it's 8% of the Dow, it drags Verizon up with it, and you have to buy Verizon. When you're buying DIA, when you end up on Goldman Sachs takes the Dow up, so more money goes into the Dow, and that means more money goes into Verizon, and more money goes into Nike and Microsoft and Merck and Walmart and American Express. And notice those are also the S&P leaders. They're the same companies. It's a lunatic system. And that's how you get these kind of crazy rallies where everything gets bought, and you think you're like, oh, there's no reason, and that's why they call it dumb money, though, because the money just indiscriminately flows into the market and gets bought for everything, whether it's good or bad, no matter how ridiculous the pricing is, it's going to keep getting bought until it stops. And the problem is, and here's the biggest problem, if I can. The problem is, for all this buying, there's no volume behind it. The average volume on the S&P, and it's being dragged down because of all this crappy volume. Even now it's still about 100 million. It used to be 120 million until about this started happening. This was like October. So around October we started grinding down from 120 million, and now the average is down to 100 million. And it was a little bad here. Here's one time 50 million, which I bet you is some kind of holiday. Where is that? Where'd it go? Oh, I saw it. Nope, I lost it. There it is. October 10th. I bet that was like Columbus Day or something like that. Oh yeah, see, October 7th. I don't know. Well, whatever. Anyhow, I had a feeling that was probably Columbus Day. But anyway, so that was an anomaly. Now we're pulling 50, 40. Well, today 40, 57, 67, 74. Last week 37. We were open this day. That was Thanksgiving. It was Thanksgiving Friday, I think. Or the half a day, so we'll count that. 56. I mean, these numbers are just so freaking low. These are 50% of normal volumes. That's becoming the norm. So, and I've explained this before. I'll explain it quickly right now, just to make sure everybody's up to speed on this stuff. The problem with the low volume rally is, let's say you have 100 cars. And let's say you have 100 Volkswagen Beetles in a car lot, and you have a town that with 100 people, and they could each afford a $30,000 car, and your Beetles are $20,000, so they could all easily afford one of your cars. So you know the money's out there, and you know the market's out there, right? So a few people buy your Beetles for $20,000, and then they get popular, and then somebody comes in and offers $25,000 for a Beetle because they really want one right away or whatever. So now your price of your Beetle is $25,000. Then somebody comes in eventually, and then a few more cars get sold, and they go to $30,000. Now you sold 10 cars, and your last car was sold for $30,000. What's the chances that you're going to sell all your cars for $30,000? Not that good, because you can't count on everybody in the town wanting to buy your car back for $30,000 when it started out at $20,000. Some people got excited and bought the Beetles because they thought they were great and they thought this or that, or they thought they were going to be scarce. But it turns out you have 90 of them. And God forbid you want to sell more than a few. Maybe if you want to have, you need money and you want to start selling them and pushing them to the market, and you try to find interested buyers, you'll find out that there are no interested buyers at $30,000. You're priced at $30,000 because you sold the last car at $30,000. So now it's assumed that your other 90 cars are worth $30,000, but that's not true at all. And also, you'll never get 35 because that's too much money. The money isn't even there for 35. So nobody who bought it at 30 is going to make money. And God forbid they try to sell at the same time as you try to sell, and everybody's screwed. And prices plummet. That's how you make a bubble, and that's how you burst a bubble. Because the stock market is not priced based on what the average shares were sold for or bought for. They're priced on what the last share was bought for. So whatever last sucker comes in and pays some amount of money because they think that it's going to go up and up forever, and frankly, if you listen to the TV people, they're telling you it's going to go up and up forever. And frankly, there's almost nobody I read right now who's telling you. And in fact, somebody asked me about that this morning. They said, why are there no, well, what happened to all the bears? And I said, look, when you're a professional blogger like me, when you're an analyst or something like that, nobody wants to hear from you in a bull market. They don't want to know about it because most people who are buying stocks are going to a stock market newsletter. They want somebody to agree with them. They decided to buy a stock. They want to go to somebody who agrees with them and likes the stock too. They don't want to talk to somebody who doesn't like the stocks they want to buy. They don't want to talk to somebody who says, I don't think this is really a good idea at this price. And that's what happens. And so you actually start losing subscribers. If you're a service like mine, you lose subscribers when you are too bearish in a bullish market. So most people who very much depend on, they freak out if they lose any revenue, they will just change their tune and they'll start acting and saying they're bullish and whatever. And that's how you get more and more of a bullish sentiment. It's crazy, it's like a feedback loop. It just keeps going. All right, so a couple of questions in. And now we'll read the comments of all the people talking about how they're being killed with their shorts. And honestly, though, I do think people are too bearish, okay? Because I don't know how... I try to explain how we're not bearish, we're hedging. We're not touching... We're talking about the shorts because we're adding short positions. But the long-term portfolio, where we have the bulk of our money, is up 130%. And the options opportunity portfolio is up 134%. I think that's up 4% since yesterday. Is it? Oh my God. Come on, this is stupid. This is just ridiculous. I think I talked about it yesterday morning, didn't I? There it is. Oh my God! Look, yesterday this is the options up. Yeah, 229,830. We didn't touch it. 234. So about $4,200. In one day, 4%. We didn't touch it. There's no changes. We didn't do anything with it. It's just sitting there. So if you want to make 4% a day, copy this portfolio, and if the market goes up like it did today, you'll make 4% tomorrow. That's okay. Here's a good point. If that is normal, then everybody in the world will be a billionaire very shortly. It doesn't take very long for you to making 4% a day for you to become unbelievably wealthy. All right, so God bless Donald Trump, because I think we'll all be billionaires at this rate. Unfortunately, we're going to be Zimbabwe billionaires. And here's Zimbabwe. Billion. Here. Sure, we'll have a good picture of that. There you go. Oh, Google with their images these days. Look at this. They have $1 trillion notes. Here. There you go. Or here's a guy going to the supermarket to get some food. That's money. But this is no reason to be bearish on the market because, frankly, inflation, here you go, $100 trillion. That's a banknote in Zimbabwe. This is the beginning of an inflationary spiral, which is going to be bullish for the market, because the Dow will go to 20,000, 30,000, 40,000. If inflation starts kicking in, and your house will go from 500,000 to $1 million to $2 million, and everybody will be a millionaire. And that's a good thing. If you have a 30-year mortgage that's fixed at 4%, and your house goes from 500 to $1 million to $2 million, when you sell your house, you will have $1.5 million in cash, and your retirement will be taken care of. I'm all for that. Inflation is great. From that aspect, everybody gets a raise. Everybody, you buy a refrigerator, you put it on layaway, and you charge it off over 2 years. By 2 years, you're making much more money. You can afford it. That's great. There's nothing terrible about inflation, but it does cause a mess economically. Causes all kinds of problems, but for the average working person, it's actually not a bad thing. Wow, geez, every time. I'm sorry. This is like, look at this. Wow. I got to stop looking over at that chart. That's crazy. It's completely distracting. It's like, oh my God. All right, so let's see. Let's try to do some questions now. ECB with more QE driving the market. They definitely said they're doing more QE, or it's a rumor? I think it's a rumor. Or did I miss something? Maybe they are doing more. Oh, maybe they are doing more QE. ECB QE. News. Ahead of the QE vote, they're extending the bond buying program. That's not a big deal. It's the same. It's like our QE. It's like we just keep extending it like it's the same thing. Okay, I don't see any news, but tell me if. All right, Craig. Well, if you do know something for sure, please put a link up so I can take a look. On TF, you only have a few days of contract left, so probability of loss is certain, or mine left over. No, I mean, I'm going to have to dump that contract and start shorting the next contract. That's all. Not a big deal. All we do is flip the contract. That's nothing. It doesn't change my position. I'm short TF at this position. If the next contract is higher, it doesn't matter to me. I'm going to sell this contract, take the loss, and short the next contract, and then I'm still short at the same place. So that's not really an issue. And by the way, I'm generally 10 short. I added 10 short to raise my basis, but I'll have to sell those 10 if we can't get out of this 1360 zone. I'm going to have to sell the 10 and just and then keep the other 10. I'm determined to keep the 10. And every time we go to another level, I short 10 more, because hopefully if we get a retrace, the new 10 will then break even, and then I can get back to 10 at a better price. That's the goal. It's not working so far. That's not true. It is working. We're at 1345. 1345 is good. I think I started like 1330 something. So 1345 means that we've been bringing the basis up consistently, but and frankly, only because of yesterday's pullback saved us. Yesterday we had that good pullback that saved us. Other than that, though, it was a disaster all the way up. Let's see. The KC trade is down 11K2. Yeah, the KC trade. The KC trade is even worse, because that's only 4 freaking contracts. You forget how vicious those coffee futures are. But this is what I want to do. I want it to be long at 150. Oh, that's KC. This is KC N7 is the one I'm in. So the KC is 142. KC July is 146. It's only 4 cents higher. So I figured rather than rolling my contract 7 times to get to July, which is where I expect coffee to start going really up, better off to just own the July contract, because otherwise there'll be some friction costs. So I was determined to own I wanted to have about 4 contracts at 150. And my average is actually 153. So I almost would have bought more, but I didn't. Well, if I wasn't getting my ass kicked on the Russell, I would have bought more of these, but I didn't. But I do like coffee for the long term, even though they had a really good crop and it kind of blew our current premise. So we're going to have to be very patient on that trade. SunPower's having a good day. That's nice. Yeah, I thought the pullback in oil would help too. I mean, it's amazing because that's not. It doesn't stop the Dow. There you go. Let's get over 1940. Yeah, get over 19,450. Why not? Why not? Yeah. Every time I look at that, I'm sorry. It's just crazy. It blew. So these are the standard deviations. So these are 5 standard deviations. Clearly, we're up more than 5 standard deviations. This space here is more than this space here. We're up 5 standard deviations. No, I'm sorry, 7 because we're up these 2 plus another 5. We're up 7 deviations from what would be normal statistically today. Okay. I don't know. I guess I'm too inside for this thing. To me, that just cracks me up. It's so ridiculous. I can't not short it. I can't. And I may be dooming myself on that trade, but I can't not short it. So oil, where were we? Oil came down, but only came down to 50 and held 50. So that's actually not so bad. It's a little bit of a sign of strength. If we look at the bigger picture on oil, okay, that's actually, it's not, well, I'm sorry, this is weekly. So, but if you look at it, we formed a good bottom at 40. We're at 50, which is the top of this low range, and we're more drifting up in the range than down. So let's take a closer look. So here was 40. That didn't last long. Now we've kind of moved right up to this range of 40 to 45 to 50. Now, so if you're dropping from 120, 120 was stupid anyway, but that's beside the point. It's really 100. We never should have been at these prices ever. So 100 would be the top of oil. Everything over here was just idiocy. We dropped from 100 to 50. Okay, so 50 is the bottom of our range, theoretically. All right, we overshoot to 40. So that's a 50, so it's a $50 drop and a 20% overshoot, which is perfectly normal. It's like a weak bounce, right, except it goes over. And then we expect to see a retrace to 60. You're going to have a strong bounce. You fall from 100 to 50, then your weak bounce, in fact, here, a weak bounce is 60, and here we had a weak bounce and failed. So now you go to the overshoot. Now we almost come back, but not quite, and now we're stuck at 50. And generally, this is all just very weak. But we are sort of clawing our way back to the middle of the range. And so it's possible that we're going to get back over 50 or hang around 50 and form that up as a really solid line. Now, it should be a solid line because $50 is right about the cost of actually producing oil on an average global basis. So that works out fine. So 50 is a good price. We do have a supply glut, though, so then you have to factor that in. We still have a supply glut. OPEC hasn't cut back yet. They're not even going to cut back until January, if they cut back at all, and if other people don't come in and step up production to make up for their cutback. And if all that goes great for OPEC, then maybe it'll take 3-6 months before you start seeing some kind of a real reduction in prices. Because don't forget that they could start making all their oil tomorrow. And you won't know about it for 6 weeks because it takes 6 weeks for the stupid tankers to go from there to here. So if they stop sending oil completely, there's still a conga line of tankers between them and us delivering oil. Every day they send a tanker. And so there's 100 tankers between them and us in a big line. And there's 100 tankers going back empty to get more stuff. So if they ever stop, it would take you 100 days before you would see that they're not sending you any more oil. All right, obviously you get the news, but I'm saying as far as physically, if you're sitting there waiting for a tanker, and someone says, Saudi Arabia's not sending us oil, you'd be like, what are you talking about? Here comes a tanker right now. And tomorrow, there's the tanker again. Okay, they're cutting you off and not delivering the oil are two different things. So cutting back and not delivering oil are two different things too. That oil, the too much oil is going to continue to come for 3 months after, not 3 months, 90 days, not 2 months, for 2 months after they actually cut it back. So think about that. So everybody's really overestimating the impact of what OPEC's doing. And in that time, by the way, if oil prices stay up, then more and more shale comes online and blows their whole thing anyway. All right, so why is healthcare selling off? I think healthcare is selling off because of the uncertainty with Obamacare. Obamacare is good for healthcare. It puts more. You got more patients. You got 20 million more patients. How is taking away 20 million patients a good thing? How can it possibly work out well? Everybody acts like Obamacare is the worst thing that ever happened. And meanwhile, if you look at IBB, so here's the biotech thingy. Here's 10 years. And here in 2010, on my 2010 Outlook, which I wrote in 2009, I guess. So when IBB was here, I wrote a whole post saying that because of Obamacare, you should invest in healthcare stocks. And I listed a dozen different healthcare stocks that I said would be fantastic picks for the Obamacare. And as Obamacare rolled in, up and up and up and up, everything went. Because you're adding 10%. You're adding almost 10% of the population of insured people. That's hugely profitable. So taking them away is not hugely profitable. Okay, you can't charge everybody else enough money to make up for what you're losing. So as much as the healthcare CEOs were not demanding that Obamacare be removed. Okay, the Republicans took a couple of guys who would complain about rates and pulling out or this and that in the plan or whatever. They didn't set their rates correctly, so they had to pull out of the plan. They took any excuse and they blew it up into this thing showing Obamacare doesn't work, blah, 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 blah. It does work, though. It's insuring millions and millions of people who were never insured before, and the insurance companies are making money hand over fist. So everybody's winning. Okay, it's not a bad program. So getting rid of Obamacare isn't good for the healthcare industry. It's bad for the healthcare industry. And they know that, but if they say something, they're crossing the Republicans, and they won't do that because that's the only guys who support them. Democrats sure as hell don't like them. So they're not going to say anything contrary to what the Republican line is, even though the line is bullshit. Something to spike the futures again. Oh, don't even tell me. Hopefully it's a blow-off spike at this point. KC finally moved up into the close, still way down, but at least it moved up instead of dropping. Yeah, it's a long-term premise, and what we just got good crop reports on coffee. So good crop reports are bad for KC. Now, your time frame has to be adjusted. If you're going to trade coffee futures, it's a freaking crop. So you're not going to know anything about the crop or the demand for the crop or the supply of the crop. It's months apart as you get your information from the agriculture departments and it's global agriculture. It's not U.S. agriculture, so we even have worse information. So, it takes a long time, and this is a long range play. It's not a short-term play. So you have to just be patient, basically. If you look at the coffee chart, coffee is very sad on a daily basis. On the hourly basis, it's sad also. On the weekly basis, not so good. But on the monthly basis, it puts it into a little bit of perspective because this is a multi-year play. We're playing coffee off a decade's low. And it goes up, and it pulls back, and then it'll go up, and it'll pull back, and it'll go up and pull back, and go up and pull back. And here we're into 2018. Now, making 30% between now and 2018 is great money. But do I know how much it's going to make in July, in January or February or March or April or May or June? Who the hell knows? Obviously, if you look at the daily chart, you don't freaking know what it's going to be from day to day. But up and down, up and down, up and down, as long as it keeps going up, and this is up from where we started because we started buying coffee down here. As long as it keeps going up, as long as it forms a new floor of 140, which is testing again from back here, and it heads back up to 160, 170, I'm going to be freaking thrilled. We're only aiming for 200. We hit 180 back here. Just didn't quite make it. So big pullback. Big pullback because we had fantastic crop reports that said there's tons of coffee out there. So now we have to find out what the demand is. And if the demand isn't good, then it's going to go further down. If the demand is good, then it'll flatten out and build up a little bit of strength. And then if the next crop report isn't good, which is a quarter from now, then you'll see some action. You can't predict this stuff on a short-term basis, and it's silly to try. All you got to do is say, this is the place at which I want to start buying. She's moving silver, what, up, I guess, right? Still going up. Unbelievable. Does the SQQ decay over time? Yeah, all the ultras do tend to decay over time. And there's a reason for that. Because, here. So, if you start out at 100, and you're SQQ, right? If the NASDAQ goes up 1%, you'll go up 2%, right? So you can go up to 102. Now, if the NASDAQ goes down 2%, you're going to go down 6%. But then that makes you times 0.94, 95.88. So don't forget, now the NASDAQ went up 1% and down 2%. So it's net down 1%. Oh, wait, did I do something wrong? No, it's a 2 times. Sorry. Okay. No, I did it right. Oh, it's just worse than I think. You start out at 100. The NASDAQ goes up 1%, so you go up 2%. So that's going to add, you're going to go to 102. Now the NASDAQ goes down. It went up 1%. Now it's going to go down 2%. You're going to go down 4%. So times 0.96. Oh, that was the wrong number. Okay. 97.92, right? Now, the NASDAQ, don't forget, is net down 1%. And you're at 97.92. You should be at 98. You've lost ground. Now, the NASDAQ goes up 1%. So now we're going to multiply you by 1.02. And you're at 99.87. That's your decay. Even though the NASDAQ is even, it's right back where it started from because it went up 1%, down 2%, and up 1%. That's even. Because you're an ultra, you're losing ground because you're exaggerating the moves, and there's a certain there's a grind where you start the moves down. And now, what's even worse though is what happens when you have consecutive down days. This is what's been happening to everybody who has like TZA and things like that. If you have consecutive down days, so let's just say it's times 0.98 every day. So you lose 1% of it. So 0.98 times 0.98 times 0.98, 3 times 0.98 times, here's the fifth one, 98. So now the index is down 5. So the index is down 5%. I think I lost track. What did I do wrong? All right, it doesn't matter. Anyway, I did something wrong because you shouldn't be above 90. But the index is down 5%. You're down more than 5% if I had done that correctly, or maybe I screwed something up. But the point is that that's how you lose ground. And also, and that's true of anything, though, because if you start out at 90, I'm sorry, I started out at 90. If you start out at 100, and the market, even if it's a straight ETF, and the market loses 10%, right? So that's going to be 0.9 is 90. Then if the market gains 10% the next day, times 1.1, you, unbelievable, hit wronky. If you start out at 100 and you lose 10%, but then you gain 10%, you only get back to 99. So the ETF exaggerates this problem because it's trading 2x the index. And that's what the decay is really. That and the fees. Also, there's a fee in the indexes that it says it's a 1% fee, but there's also a transactional fee if they churn, and the more they churn, the more the thing moves, the more volatile something is, the more churn there is, and that causes like way more fees going into the ETF. It's very profitable for them, but terrible for you, and that also causes decay. So these ultras tend to have ridiculous fees and terrible churn rates, and then the math of the thing causes a decay. But when you have multiple days down or multiple days up, it exaggerates it so much that it just crushes the thing. And TZA is a good example of that. What are my charts? I never have those charts. TZA has just been getting crushed. So it's down. So here's a good example. It went down. So this is a 3 times ETF. It's from 33 to 20. So it lost 13 out of 33, which I guess is about a third, a little more than a third. 13 divided by 33 is 40%. All right. So TZA is down 40% from before the election. And the Russell is up let's see, that's 1156 to 1355. So let's call that 200 divided by 1150, 17%. So 17% times 3 would be 52%. It's actually not even doing as badly as it could be. That's interesting. So it's funny, people complain about TZA, but you know what? You're actually getting a good deal because the Russell's up 17% and you're only down 40%. You should be down 50%. So I like it though because of course if the Russell starts coming down, this is why I like TZA as a hedge, because if the Russell comes down 10%, this goes up 30%, this goes to 26. On a 10% move down in the Russell, this guy's going to jump up to this blue line. But, then again, what are the odds of that when you have this going on? Oh my God, look at this. It's going straight up. They talk about parabolic moves, but this isn't even a parabola anymore. This is just a straight line going up. Wow. This is some historic stuff, people. I hope you're appreciating it. All right. So, yeah, I meant to get long, so I forgot about that. So it was nice and low. Just great companies are onshoring to the start of the roaring 20s. Yeah, I believe they're onshoring when we see it. It's just, well, I mean, to some extent, wages overseas have been rising, so it doesn't make sense. And plus, the automation that we have now Also, you don't need that many workers to make stuff. So it does make a little bit of sense to bring some of your factories in if they're affordable, but it's hard to count on something like that. TF and Casey, why do you sit and watch a loss versus a tight stop and wait for the trend to change? No, frankly, that's how you should play it, but I'm working all the time. I don't have time to sit there and play with it, so I just let it ride, and I'm doing a strategy where I double down and reduce my basis, and then when it pulls back a little bit, I then cut back on the trade. It's a conviction strategy, which we talk about in our strategy section, in fact. It's not the best way to play. You should use tight stops, and you should be getting out of these things more quickly. But also, this thing today was just an incredible blow-off. I mean, thank God I wasn't shorting down today. But today was more of a blow-off move up. Frankly, unless you're sitting there watching it the whole time, I just missed it. That's the bottom line. I mean, I was doing stuff. I had a busy morning, and it went flying on me, so I had to do that. But yesterday, but meanwhile, I'd done the same thing that I'm doing now on the way up for the last week, and yesterday it all paid off, all in one shot. Because you never quite know when you're going to get that pullback. But on the other hand, I'm not going to go to sleep with 20 short contracts. That's crazy. I might take 10 or 5 into sleeping, and then when I wake back up, I'll see what I have to do to add more positions. But I really, really, really feel this is it. Could be wrong, but. And like I said, you're talking about a math. I want to have a lot of contracts that finally does turn. But it's definitely, but look, unless you have tons of money that you don't mind gambling with, I certainly don't recommend it. It's not a very safe way to play at all. Earnings trade on Costco. I had no opinion on Costco at the moment. Where are they at? Probably high in the channel. Actually, well, look at that. I like Costco. I mean, look, for me in earnings plays, I hope they miss so that I can buy them. That's my earnings play. I hope they drop $10, and then they'll be very attractive. I like Costco down here. I thought they were higher. I'm surprised. It's a great company. They do a lot of good stuff. They make great money, but I just don't. But it's also nothing I'd be excited about paying 10% more for. On the other hand, though, if you look at Costco, I bet they have some good prices for options. So, see, sometimes I might not like a play, but then I look at the options prices and I say, ooh, that's really attractive. So if we look at Costco, they're at 152, and let's see how much we can buy them for. So January 19. Okay. So you can sell the 135 puts for just under $10, and that nets you in for about 125. So if I was going to take a play ahead of earnings, I think I'd go with that. I think I'd sell those puts because here's the thing: if you want to buy a bull call spread, okay, it's not going to change based on earnings. All right. So in other words, if it goes, here's why. 152, right? All right, so let's say we took the 140s, which are $24, and we sold the 160s, which are $13. So that's 11. So it's a $20 spread for 11. The 130, did I say that right? 140, sorry, 140, 160. Now, imagine Costco goes $20 down. Then we'd have the same, then we'd be having the spread would be like the 120, 140 spread, and the 120s are 37. And the 140s are 23. So that's, I'm sorry, they'd be 24, because it says 23.50, but it's 23.25, so I call that 24. So, now I forgot what the number was. 37, so these are 13. So, this spread was 11, and if Costco moves $20, that spread will get $2 cheaper if it drops $20. So, I have no urgent need to get into the spread. All right, it would be nice to get it $2 cheaper, but it's not an emergency to get into the spread. I'm better off waiting for earnings so I get a better idea of where I'm going to target my spread rather than jumping into a spread, which locks you in place. It's hard to wiggle out of a spread once you put yourself in it, because the options you sell will move as much as your options. So if you want to get out, it's kind of a pain in the ass. On the put side, however, I'm comfortable owning Costco for $125, which is $25 off, like 10, 15, 17%, 18% off. So I'm comfortable owning Costco for an 18% discount, and I can commit to that now by doing this. So ahead of earnings, because now if Costco moves $20 down, then you'll get the price of the 115 puts, which is $4.70. That's half. So here you're losing $4 if it goes the wrong way on you. Now, if it goes the other way and you're at the 155 puts, those are 17. All right. So in other words, if Costco drops $20, your puts will go to 17, but Costco's still going to be at 132, and your net is 125. Sorry. So your net's not a big deal. And then the bonus is you get to then buy a cheap spread at lower strikes on the bull side. So you understand it? So in other words, what I'm saying is you have to really want to own Costco. Otherwise, what the hell are you doing with the earnings play? Stupid. You shouldn't gamble on earnings. But you say, look, if Costco got cheaper, I would definitely buy it. So I'm going to commit right now to buying Costco for $125 net by selling these 135 puts for $10. Then on earnings, I'm going to probably add a bull call spread. And if Costco goes up $20, if Costco goes up $20, you might say, oh well, the hell with it. Okay, it's like, okay, so I'll just make my $10. That's not awful. If Costco goes down $10, $20, or stays flat, then you say, oh, now I've got a great price on a bull call spread, and I'll buy that. Now I could buy this 120, 140 spread for $11 instead of $13. And that's with Costco at 135. That's even after it drops $20. You can buy the 120 spread that's $15 in the money for $11. And that, paired up with the puts you already sold, puts you into that spread of $1. So that's the way I would play it. You don't have to take every leg of your spread right away. You can work into it, and you start off by saying, do I really want to commit to own this company? Frankly, any company that you aren't willing to commit to own, if it drops 20%, you shouldn't be betting on it in the first place. Not bullishly, anyway. Because why would you make any bullish bet on a company that if it drops 20%, you wouldn't buy it? So SQQ should only be bought for short periods that follow a move down in the NASDAQ. Yes and no, because like in the long-term portfolio, we have an SQQ. Gee, we make another 5% yet? Yeah, we did. We just made 2% in the long-term portfolio. All right. It's just a joke. Oh, it's not in the long-term portfolio anyway. It's in the short-term portfolio. Oh, what do we lose in the short-term portfolio is the question. Aha. This has got to be getting killed by now. Oof, 358. Yeah, this was this is down. I think we were 360 something yesterday, so it's down 5% also. But this portfolio is much smaller than the long-term portfolio, so this going down 5%, and the long-term portfolio is up 2%. The long-term portfolio wins by a mile. SQQQ. What? Oh. Nope, that's not the spread I was thinking of, because this one we only have this spread. I mean, we only have long calls. And you see, we have the March 12 calls naked, and they're barely decaying. 290 to 228 is really not that bad, considering how bouncy the indexes have been. So it must be the 5% portfolio, where we have the spread. That's the options opportunity portfolio. That's just the old name of it. Here. So what we did here is we have the March 12 calls. That's not the ones I was thinking of, is it? Do we have other ones, or is that it? Why do I have this illusion that we have these 2018 SQQ? Oh, because it was TZA. It's TZA that we have 2018. I'm sorry. In TZA, we took the 2018, same thing, the triple ETF. We have a 2018 calls. And yes, they will decay, but so will the 35s that we sold. Meanwhile, these guys are in the money. So we're perfectly happy with that trade. All right. Oh, excuse me, I got to get something. I'll be right back. Amazon. That's like 3 times a day lately. Freaking Christmas. All right. Where are we? It's really not a triple going up. It depends how it goes up. When they go up in a sort of sawtooth fashion, they get messed up sometimes, and that usually is how we do go up. I would never take these things literally. It's like a rule of thumb that it's a triple ETF. It doesn't actually, although it's intended to work that way, it doesn't really work that way. Move in YM is only 1.33%. Is that why we've been lulled to sleep? You mean the move today? Yes, no, well, what it is that the volatility has been so low, that the ranges have been so tight that, yeah, there's been no expectations that we'd have a breakout like this at this point. Cost or BZ for Butterfly? Well, cost is expensive. I don't like these expensive stocks with Butterfly because you can get burned for a lot of money in proportion to the portfolio. Like, you know, because if you're playing $150 stock, you can take if it moves 20%, it's $30. You get blown out of 5 contracts for let's say $20 of it is a loss to you, and that's $10,000 loss in a small portfolio. You know, and it's 5 contracts, so it's not, you know, it's just not that sexy. Also, something like Costco, the range of the prices you have to lay out for the long-term positions are also expensive. So it doesn't make a good candidate from that standpoint. And it's kind of rangy. It's not bad. It's generally rangy, and it's not even that wide of a range, but it's just messy to play when they're that much. You know, I mean, I would play it myself personally based on the range I'm seeing there, but I know that I see people, when I put it in the portfolio, people get themselves in trouble following it. So I tend to stay away from those kind of things for that. As to Verizon doesn't have good enough option prices. I know that already. Also, look at it. It's actually quite a mover. You go from 42 to 55 and back to 46. These are pretty big moves. You don't really want that. You want this. This is what you want to see in a Butterfly play. You want to see a tighter range because you're selling both sides of this. And so you don't want to get caught too often with a big move. This thing makes too many big moves. And you got to look at a quarterly basis, not a weekly basis or a monthly basis. It's how much does it move in a quarter. And so in Costco, you know, you've got to move here from 140 to 158, from 158 to 137, 137 to 169, $30. So, you know, you're sitting here, you think you're in the middle of the range, you sell your 150 puts and calls, and all of a sudden you're at 169. And let's see how much we can sell the 150 puts and calls for. So let's say we sell we wouldn't sell January, because it doesn't pay enough anyway. Let's say we sold the April 150 puts and calls. These are 5 something, and these are 8. So that's going to be $13, $14, let's say. So $14 is your safe zone, and this thing has moved $30. Well, it depends where you catch it, but let's say right now. So let's say we had a move that was $20-something, and you're losing $7 per contract. Okay, it's kind of a nasty loss. Not that it doesn't happen. I mean, it happens all the time in the butterfly portfolio, but we like it not to be predictably happening. You know, I mean, no matter what you're doing, it can happen, but you don't want to be in a stock where it happens on a regular basis where, look at this thing. Well, that spike's ridiculous. Here's 130 to 167. That's a $37 move. You know, it's not good. It's a little too volatile for the kind of thing we'd like to play in that portfolio. Well, like I said, I would play because it's fun. I mean, we're playing Apple, and Apple's kind of volatile too. But I don't mind watching Apple and riding on Apple. You've got to keep your eye on these things, though, if you're going to play the volatile one. IBM turning bullish. IBM was our runner-up for the trade of the year this year. So IBM lost out to natural gas. So let's see. IBM. Well, it's in the Dow. Of course it's going like this, right? So IBM for the year. See here, we pick our trade of the year here. Was it 130? When it went down to 113 to 115 and stuff, I actually said IBM should now be our trade of the year because you know we'd already called it. We already made it natural gas here, but when IBM did this, I was like, oh shoot! I'm like, at this price, I absolutely want IBM. But it's right at our price target. Our price target was 150, so it's exactly where we thought it would be at the end of the year. I think we have some IBM in our portfolio, but not as much, frankly, which we should. And UNG was our trade of the year. And it hasn't really gone anywhere by comparison. We picked it up, this is when we liked it. UNG was 7, and now it's just over 9.15. And we took a 2-year trade there, but our trade is meant for 10. So we were only looking for 10 when we started. And we actually cashed this trade out already in July. Because when it spiked up here and got to 9 plus, we took the money and ran. We're actually in a new trade now that we initiated a bit lower. So in fact, what's our long-term play on that? Where are we? In the 5% portfolio, in the options, I got stuff in the options opportunity portfolio, we have a 10 target. We own the $5 calls. This is for next year, next 2018 January. So we have the $5 calls, and we have 20 of those. We sold the $10 calls, and we sold the $10 puts, which is pretty aggressive. And if this one plays out, we have 20 of these. That'll be $10,000, but we have a big credit. 45 minus $7,000 credit on the spread, and we get $10,000 at 10. So we make $17,000 after starting with a $7,000 credit. That's a nice little trade. In the long-term portfolio, I think we have UNG in the long-term portfolio. Oh no, we just lost 2%. Man, that's volatile. These prices are all over the place. UNG. Yeah, in the long-term portfolio. Oh, we have a much more aggressive play. We also sold the $10 puts, but we bought the $8 calls flat out with no covers. So that one we have a more aggressive stance. Although it's really a very small position for the LTP. I'm not sure why we have that. It's kind of weird. Considering how much it is, it's a very, very small position. We'll see how that goes. Do we have any short-term portfolio? Thought we had somewhere else. Nope, no UNG there. And what is that butterfly portfolio doing? $236%. It's just ridiculous. Everything is ridiculous in this market. I knew it. We do have UNG. Now, this is not a butterfly play. Actually, we just bought the UNG. I think we started with a butterfly, and then we just ended up being long. So here we have the 7-12 spread, and we sold the $12 puts. So that's uber aggressive. But look how it's working out, because we sold the $12 puts as a very aggressive long play. We sold them in December of 2015 for $5.38. So our net there is $6.62. So back in 2015, in December, down here, wow, what date was that? What an incredibly smart play that was. Holy cow, that was ballsy. Okay, December 17th, 2015, we took a very big play, and you can't see exactly when December 17th was, but figure it's right here. So as it started going up, we took this big play where we sold the 12. It was under 8. It was more like, it was like 750 or something. We sold the $12 puts. So that way we get every single penny of the move up, right? Because we sold them for $5.38. So everything above 7 for us is everything above 640, 662 is huge profit. And we're reaping the benefits of that because we're up 35% on those, which is $8,000. It made the trade, look at this, we got 24,000 credit there and a 44 credit there, so that's 28,600. So the net credit on this spread was $20,000, and if the spread pays off, it's going to be 5 times 40 is another $20,000. We'll have $40,000 profit on this spread if it pays off. Now, it's in the butterfly portfolio. I kind of feel bad not making it into a butterfly play. I mean, it's already up $10,000 something. But that's out of 40. It's going to make another 30 if all goes well. So on the one hand, it's not a butterfly play, but on the other hand, it's going to make $30,000 if we leave it alone. So I guess I'm inclined to leave it alone. So this spread 18 minus 12. Yeah, this spread is right now about $6,000 and pays back. 15, 3 is 18. That's another 1,000. It's 19, 7,000. So it's about a $7,000 net on the spread right now, and this spread pays $20,000 back if all goes well. So as a new trade, it's going to make $13,000 off of $7,000. Wait, no, sorry. It's a $7,000 credit, and it'll make $27,000. There. That's what I meant to say. So yeah, this spread has $27,000 more dollars to go. So honestly, there's not, even though it's made $12,000 already, it still has $27,000 to go. So I don't know. I have no reason not to like this spread. So you might have missed our great entry, but not by that much. But anyway, that's why. So that's why it's our trade of the year, because I was sure enough. The difference is, how positive was I that we would make money on that trade, so we could go balls out and make a really aggressive play on it, versus IBM, which I thought at the time was more risky, and it was more risky. I'm sorry, it's not like I was wrong, because this is what happened to IBM after December. All right, I was worried it was going to go lower. Once it went lower, I got super gung-ho enthusiastic about it, but I was worried about this dip. Just like right now, I'm worried about the entire market doing the same thing. But not today. It says, nope, not today. Uppy, uppy, uppy. What is that? 48.40. Wow. No reason to go anywhere else but up. Leverage ETFs do well when the market moves. Yeah, I just said that, didn't I? I said the consecutive moves up or down will do that. Well, depends if you're betting on it or against it. But yeah, if you're betting in the right direction, a consecutive move up compounds your returns very fast, and choppy markets destroy them and chew away their value. Are we still in your July USO 912 bull call spread worth holding? Yes, although I'm bearish on USO at the moment, I'm bearish on oil at the moment. It doesn't change the fact that in July I think we'll easily be over 12. So yeah, I'm not changing that one. SunPower 13%. Wow, that's in the options opportunity portfolio, isn't it? $134. Holy crap. SunPower. There it is. That's that's only even. We're even on our trade after all this mess, because we okay. What do we do here? Wow, we have the 5 calls. Oh, we're super aggressive on this one. We have the 5 calls. We sold the 10 puts. Did we really sell them twice, or is that a mistake? Apparently, we sold them twice. I'll have to go back and check that. It seems like we sold them twice, but I can't see how a month apart it could be a mistake. So we sold the $10 puts, which is an aggressive sell. But don't forget, though, we sell them for $3 or $4. So let's say we sold them for $3.50 average, right? That means we're netting $6.50. If you sell the $10 puts for $3.50, then you're net $6.50 in. So we're at $7.90 now. I don't care what this says. We make money at anything over $3.50. I'm sorry, over $6.50. So all we did back in August and September is put our foot down and say we think. Well, now when I fill a put above the strike, above where we are, it means I'm really confident we're going up. So this was August and September. So here we sold some here when it was at 10. And then when it dropped, I see. So when it dropped again and we got a better price, we sold some more. And I'm just dead sticking to my $10 target. That's all. I was very confident in my $10 target. I considered all this to be silly. I considered this to be silly too. And at what point did we add? We added in November, we added the long. That's what happened. So November 18th. No, that can't be this year. That doesn't make any sense. Otherwise, I remember doing it. Oh, no, we did. I don't even remember doing that. So on November 18th, or I guess it seems before Thanksgiving seems like forever ago, doesn't it? So on November 18th, we added, well, that's too short term. So on November 18th, as I was getting sick of it being down here, then we just bought some $5 calls to take further advantage. But it doesn't change my target, and so by selling these puts, everything above 650, where we did form a nice base, anything above 650, we make money until we make 100% on those short puts. And when we get to $10, we make, well, we're going to make $4,000 on this one and $29 on that one, so we can make $6,900 over 10, plus if it's over 10, these will be worth $5,000. We paid $33.50 for them, so these will be worth. So that's $6,900 there, plus another $1,150 there, so $8,000. So we make $8,000 off this trade, and again, it was a big credit as we took it. So those are fun plays. It's a good way to play. But that, and by the way, whoever asked about the value before, that's what I consider a value play. It was down. It was down with the sector. It didn't particularly have any problems if people were getting out of solar. And I didn't see any, for me, look, solar is the future. It doesn't make any sense to get out of solar just because oil prices came down. It's like solar is still the future. It might take longer. It might have a bad year in between here and there, but this is a crazy low price for SunPower. It's ridiculously underpriced. Even now, it's still good. It's still great for a new play. Well, like I said, the trade we have is barely over even, and it's got incredible potential. This trade net fee is minus 1,000 plus 1,350. So this trade right now is basically the same price as we entered it, and it's got 69, 7, 8. It has an $8,000 upside potential. It's a good trade. You can do it with one of these. You don't have to sell both. I mean, so I would just sell 10. Sell 10 puts. They're $393 right now, so you can sell them at the high price of $4,000. And you buy these for $33.50. I'm sorry, no, they're not $33.50. Well, they're $47. So your net would be $700. And you have the $5 call. They can go up unlimited. And the short 10 puts. So once you get over 10, you're going to get at least on your $700 net cash investment. If this thing goes over 10, you are going to get at least $5,000 back off your $700. That's a $4,300 profit in well, if it hits 10 in 2018, it doesn't matter these are 2019 calls, they'll still be worth more than $5. I mean, hell, they're worth $5 now. They're $4.70 now. So the point is, these will expire worthless, and once these expire worthless, your net of 7 is locked in. Your net of 700 is locked in, and then you're sitting on your $5,000 puts. But they could be, if you're at 15, you could have $10,000. So I love that as a new trade. Have you decided to stop picking for 2017? I've not. I can't do it. I've not found anything. I mean, the market's too stupid. Maybe it'll be SunPower. I don't know. I just, you know, look, the trade of the year, DBA is in contention. The trade of the year is a stock I feel almost certain, a trade I feel almost certain is going to make at least 300% back on cash. You know, I mean, not including the I am blanking on the word margin requirement. Can't believe you forgot the word margin. So as far as your cash outlay, though, I look for something that's going to return at least 300% on cash that I feel so confident about it that I would put 20% of my portfolio into the trade. And we haven't missed one yet. Every year we've been nailing it. I mean, that's why in the butterfly portfolio, the only trade like that is the UNG. So it's our trade of the year. And at some point last year, I said, how can we not put our trade of the year in the butterfly portfolio? It makes no sense. I said, it's the best trade that I know of. It's an almost sure thing. And as it turned out, it was a sure thing. It worked out perfectly. So I look to something like that. I don't have anything where I really have that feeling right now. So I'm putting it off. Usually I take it by Thanksgiving, but we're not usually this crazy in the market. I can't in good conscience just, I can't pick something for no reason. It's even worse if I think I've got like 7 in a row. Like I've got a 7-year streak of perfect picks. I don't want to blow it just because I rush a pick. But on the other hand, I'm feeling the pressure because I really don't want to go into Christmas not having it. So I will work on it. Let's put it that way. What are your candidates for trade of the year? Okay, the one that springs to mind right now, not SunPower, is the DBA. I feel very, very strongly that there's it goes on. It's the same as my coffee pick, though. It's the global warming is causing crop damage. There's going to be a rise in prices. Plus, we have inflationary pressures all around, and this is a silly, cheap price for DBA. Now, it doesn't have to go up a lot. That's the thing. It doesn't have to be the best performing stock. It has to be the stock that I'm sure that we can make money on. So, if you take DBA, and I say, okay, look, DBA is an ETF. It's not likely. It holds futures. It holds hard contracts and so on and so forth and all that. So it holds all the futures contracts. It's not likely to go much below 20 based on the basket of things that it has. It has wheat, cotton, hogs, beef, all, cattle, corn, probably some coffee in there too, all kinds of stuff. So of all these things, this basket I would be very happy to own these things long-term as a hedge against inflation for $18. I got no problem with that. So therefore, selling the $19 calls for $1 or 95 cents is a no-brainer. Okay? There's no reason not to do that. 10% below where it is now, absolutely I would own it. Got no question about it. So now I have 95 cents. Now, obviously, if I spend the 95 cents, then my net is 19. Still don't mind owning it for 19. So basically, it's free money. Okay, on the off chance it goes below 19, I'm happy to own DBA at that price. But basically, it's free money. So I'm going to take my free money, and then I'm going to buy a spread. Now, what spread would I like? I don't want to pay a lot of premium. Oh, this is 2019. I don't think I have to go to 2019. I think I can go this year. So the $19 calls here are $1.80. I would say since it's here, let's call it let's say $1.87 just to split the baby here. So $1.87 here, and these are clearly at least 87 to 21 calls. So here it's $1, right? On this spread it's $1. And I sold these for 95, so my net on this spread, on the 19, which is in the money by $1, on the 19.21 spread, my net cost is a nickel on a $2 spread that's $1 in the money. So this spread will make $1.95 on a nickel if DBA is over 21, if DBA goes up 5% over the course of this year. All right, so now, the only problem with that, though, is that if you want to drop the price to a nickel, you've got to buy a lot of DBA. I don't need to make a 1,900% return on my money to be happy. What do we want to make? We want to make about 300% or 400%. So let's say we could actually sell a lot less. So now let's think about it. So let's say I sell, instead of selling all of them, let's say I do a quarter sale, and I sell 10 of these for $950, and I buy 40 of these for $1, so that's $4,000. So now it's $4,000 less $1,000, just to round it off. So it's $3,000 net, and now I have an $8,000 upside at 21. So I'm sorry. So I spent $3,000 net, and I have an $8,000 upside. So now I can make $5,000 off $3,000. I'm not really satisfied with that. That's why this trade isn't doing it for me as a trade of the year. But you see the logic. I'm saying I want to find a combination I'm very comfortable with that's going to make me 300%. This makes 150%. And I feel amazingly confident in it, but I want to find a way to make it 300%. So I might go to Whole Foods or something like that instead and make it more interesting. So let's take Whole Food. WFM. And see if they're in an attractive place. And they are. Whole Foods is a nice attractive place. They're at 30. So let's say instead of selling DBA puts for $1, I sell Whole Food puts. And I also have to look at the net cost of how much my ownership is. So WFM. So in DBA, I get $1, but I have to buy a $20 stock. In Whole Foods, if I sell the $30 puts, $27 puts. We sell the $27 puts for $350. That's not that much more than 20, but I get $350. Now that's interesting, huh? So in other words, if I sell a DBA put, I have to buy DBA for 20 or 19. If I sell a Whole Food put, I get 3 times more money, and I have to buy Whole Foods for 27. That's not that much more than 19, so I'm getting more bang for my buck selling Whole Foods puts. So now I could sell 5 Whole Foods puts, and I get $1,500 or $1,750. So now I get $1,750. Aha! That gets more interesting, because now if I go back to DBA, well, I know what my DBA was. It was $4,000 to buy 40 spreads. So now I've got $4,000 minus $1,750. And so let's review that. I'm selling 5 Whole Foods $27 puts, 2019 $27 puts, for $1,750. I'm buying 40 of the DBA 2018 1921 spreads for $4,000. And now my net on the $8,000 spread is $22.50, right? $22.50. So now my net is $22.50. And I make $8,000. So now we're talking. Now we've got a spread I can deal with. Oh, no. Oh, there it is. My calculator. So $8,000 minus $22.50 net cash on that spread is $57.50 divided by $22.50, 255%. Now I'm liking the spread. All right. So now, what's my worst case scenario? My worst case scenario is I'm forced to buy 500 shares of Whole Foods for $27, which is a bit over $13,000. 500 times 27. What? No, that's divided. So 500 times 27, $13,000. All right. So your risk is owning Whole Foods for $13,500. It's really your only risk on the trade. Plus the cash, the net 23 on the spread. So you've got this upside potential of, I forget what it was, like $8,000 or $7,500 is your upside potential. And if it all goes badly, you're not losing $13,500. You own Whole Foods for $13,500. Whole Foods isn't going to zero. So you're not going to lose $13,500. Now, what's my logic here? Because it's the same premise. Because if Whole Foods sells food, which they do, if the cost of food goes up, Whole Foods gets to raise their prices, and they'll actually make more money because they're a high-cost food place. Plus, they use local growers. They're not as tied into national prices, and they make their own deals. So they actually benefit. When food prices rise, their prices rise slower than other supermarkets. So we went through this a while ago. That was, in fact, we made great money on Whole Foods because we played it when food costs were rising. And we had long talks about this in the chat section because what was happening was it was getting to be not really more expensive to go to Whole Foods to buy vegetables and fruits than it was to buy at the grocery store. Whole Foods caught up. Even they started out more expensive, but then the grocery store prices started rising, and Whole Foods started catching up. And that's still been going on. And those raw food costs are up. And Whole Foods is it's still a fabulous operation. I mean, people obviously don't respect it, but for a grocery store, they make fantastic money. In fact, we'll take a look at it. WSM. Yes. That's just what I meant. How do you get to the thing? God, I hate this thing. I guess we'll start from there. So Whole Foods market, $15 billion in sales, $500 million profit, and their market cap is $10 billion. So they're trading at about a 20 times multiple. That's not terrible. And they're paying dividends 2%, by the way. See, they're very flat, though. They're flat on sales. They're flat on earnings. There's nothing exciting going on here. It's just a good, reliable little company, but a good deal at this price. It's reasonably priced, and I like reasonably priced things. So, it's not sexy. It's not going to do a lot, but it's a reasonably priced thing. And if I did own it, here's the thing. If you do end up owning it, by the way, another thing is if I do own a stock, I say, well, if I do end up owning Whole Foods for 27, then what happens to me? Well, WFM. So here's my fate. I get Whole Foods assigned to me for 27. I would go out and sell the 27. I would sell the $27 call, but let's say it would be the price of the $30 call since we're at 31. So I would sell the $30 call, 27 calls for $6, $5. Now I've got my basis. So as soon as I get assigned the stock, I'm going to sell 2-year out call options for $5. That's going to knock my basis down to 22. So when I sell the 27 calls for $350, I'm agreeing to buy it for net $23.50, but I'm not really even doing that because then my net's $23.50. Then I'm going to sell calls against it for $5 or $6. That's going to bring me down to $17.50. So do I want to buy Whole Foods for $17.50? Yeah. Then my PE is 10. So it's like a chess game. You have to think about the move and the move after that and the move after that, not just the one move that you're looking at right now. So that's why I feel very comfortable selling the Whole Foods, and that makes me more comfortable with the whole trade because my downside to owning it is not bad. Now, interestingly enough, though, obviously I think of all this stuff when I'm making the trade of the year. The people who follow the trade of the year don't think that way. They want to see a win. They don't give a crap about the downside of owning it and so on and so forth. They want to make frickin' money. So, I do my best to do that, but my consideration when I'm looking for trade of the year is I have to think about what happens if it doesn't work out and what's your escape plan or what's your long-term ownership. And again, it's only 500 shares the way I'm planning this trade. Although frankly, since it's only $13,000, I might go for like a $20,000 risk and lower the cost basis so I can get over my 300% threshold. But that's the kind of trade I would set up. So. But the key is DBA. It's not Whole Foods. It's not about Whole Foods. I'm just looking for an offset that is appealing. Why does that say 28.74? It must be an old tape or something. Weird. So I'm looking for an appealing offset, and Whole Foods happens to be one that springs to mind. It's in the same vein, basically. If the market keeps going, trade of the year could be short. Yeah, I've never done that. Never had the trade of the year be short. I honestly, the trade of the year could be TZA. I know people are getting crushed on TZA, but you look at TZA right now. Well, it's like I said, a long-term position. If we have which portfolio is this? There it is. Right now, it's 510 and 262. So basically, it's about 250. So for $2.50, you're at 20. You have a $15 spread for $2.50, so a $12.50 potential upside. All right, is 655. So you have a 500% upside on this trade at 35. Now, it's not that likely you get to 35 because to get to 35, TZA has to go up 75%. That means the Russell would have to drop 25%, even if it's directly correlated. So that's not that likely. But seeing those kind of numbers means that we can probably look at some combinations that pay off really well. So if we look at TZA. But you see, my degree of positivity on that is not that high. So it wouldn't be a trade of the year because I just don't feel that strongly that this is the best thing you can do with your money. Here you go. The $18 calls. Oh, that's January. Forget that. Sorry. So for the end of the year. Oh, there's not many choices. That's a shame. So the $15 calls are $6.75. Okay. So $6.75, and let's go to the 25. The 25 is $3.90. So basically, this $10 spread is $3, or even less than $3. But whatever, it's $2.80. Let's say. So this $10 spread is $2.80, and it's half in the money. I like that, right? So all the Russell has to do, if it's flat, you're going to make money. If it goes down even a twitch, you're going to make money. So that's a nice hedge right there, okay? It pays, even as a straight hedge, if it's $2.80, it pays you back 4 times. It pays you back $10 on $2.80 just by itself. Then all you have to do is take an offset to it. Now, what's an offset to the Russell? You say to yourself, well, what would I not... Now, what's your assumption? If you lose money on the hedge, it means you got to make money on something else. So if you lose money on the hedge, the Russell must have gone up or stayed flat. Now, if the Russell went up or stayed flat, that means that the average stock went up or stayed flat. So then there's a ton of things you can do. And I know exactly, as I say that, I'm like, oh, I know what. Gilead. So Gilead is a pharmaceutical company. They've been totally down in the dumps at $72.50. They're fantastic, but I think their PE must be like 6 at this price. Now, they've got some drugs that might come off schedule, and they've got some competition coming in, and blah, blah, blah. So their PE goes to 10 or 12. I still like owning companies that have a PE of 10 or 12. But we're not going to own it for $72 anyway. We're going to sell, how much was those? Was that $280, right? So we're going to sell the $50 puts, $72 stock, $50 puts for $360, let's say let's say $360. So we sell them for $360. So let's say we sell 5 of those. All right, and we sell 5 of those, and that's going to be for $360 is 1,500. 5 times 360 is what? What did I do wrong? 5 times 360, 1,800. I got it right. Damn it! I hate it when I'm right and I can't trust myself. So it's $1,800. So now I've collected $1,800 to promise to buy Gilead for 30% off. That's free money. Okay, I'm sorry. That is I'm not going to justify it. That's free freaking money. They're handing out money. Do you probably? Okay. Let's say you have a house, and you bought your house for $350,000, and now it's being valued at $300,000. And then somebody says to you, okay, will you promise to buy this more? Will you promise to buy the house out for $200,000? Well, you know what the house is worth. You live in it. It's a perfectly good house. $200,000 is a ridiculously low price. So if somebody wants to pay you money to promise to buy the house for $200,000, you take the frickin' money, right? That's what this is. Okay, so that's my explanation of Gilead. So if you analyze it and look at the stock and all that, that's free money. So we have about $1,800 of free money, and now we go back to TVA. And we say, well, good, how many of these spreads can we buy? So we got the 15s, I'm sorry, what was it? It was 360 we decided, and this was 7, well, let's say 7 and 360. Wait. All right, let's say $3, okay? So if they're $3 for the spreads, and we have $1,800 free dollars, that means obviously we can buy 6 of them for no cost. But let's buy 12. Let's buy 10. Let's just buy 10. So we buy 10 of these for $3,000. We sold the other ones for $1,800. That means now we're spending net $1,200. So now it's $1,200 for $10,000 worth of spreads that are, at this moment, $5,000 in the money. So your upside is $8,800 if the Russell even twitches lower. That's how you make a hedge. Okay, people who have hedges in TVA that are going badly are doing it wrong. Because that's how you make a hedge. You should have a bullish offset. That way, if the market goes up, you make money. Unless you're very unlucky in the stock you take, but if the market goes up, you make money, and if the market goes down, you make even more money. That's the way it works. And by the way, don't forget, this spread makes $8,800 if the TVA goes down. So if TVA goes down, and you get assigned Gilead, you get assigned 500 shares of Gilead for $25,000, this $8,000 pays for 1/3 of that. That's a great trade either way. The only way you get screwed is if the market goes down and Gilead. If the market goes down, the market goes up and Gilead goes down. You get screwed if the TVA goes up. If TVA goes down because the Russell went up, but Gilead for whatever reason goes down to below $50, then you get screwed. But the only way you're screwed, though, is you own Gilead for $50, which I still think is a good outcome. It's hard to say it's a bad outcome. Wasn't there something happening at 3 o'clock? Oh, yeah, consumer credit. Consumer credit's coming out in about 8 minutes. So I'm going to hang on to that because that's an important data point. What the hell? 1363. Jesus Christ. Yep, we should have stopped out of that, Russell. Holy cow. 1363, high of the day. 17,000 losses. Shit. All of it today. Just a terrible, terrible day. It's the wrong day to be long to be short on the Russell. Several times. All right, so that's an interesting trade. That TZA I like a lot also. Not the trade of the year trade, but it's a good, very good hedge. Especially with the Russell of this insane prices. It's just crazy. What were we saying? Consumer credit. That's what we're going to look for. So we'll take a look at Seeking Alpha's news and see if they have it. They won't have it yet because it's a 3 o'clock report. But maybe we'll see what other news is going on, right? Ew, what is this? Why does it not show me? I have that problem on this machine. Top news, all news. How about that? Ah, there you go. That's why I had the wrong selection. Mozambique natural gas, sales rumors to America, Emirates take Airbus, positive outlook lifts lows. See, this is what's going on. You see how these people, everybody is boosting outputs, boosting guidance, boosting this, everybody's, because, look, hey, the market's great, people are doing something, money's coming in, so therefore we're all going to raise our guidance too. That's another level that you hit when the markets start going crazy. SodaStream, oh, come on, people are buying SodaStream. You've got to be kidding me. Okay, that's really it. Okay, that's totally fine. The market's completely topping. Oh my God. SodaStream. Oh wow, look at that. I haven't thought about them since they were major short here. I haven't even thought about them since they bottomed out. I was sort of like, I kind of felt like they were dead. I haven't even given them a second thought. I didn't realize they came back like this so far. Maybe an interesting short again. Unless somehow they figured out how to make some money, but I don't think so. SodaStream getting towards $1 billion market cap and $400 million in sales, which is declining. Profits are, there are no profits. $12 million. $1 billion market cap on $12 million in sales, declining significantly from where they were. So let's look at the quarterly. Maybe they've had some incredible uptick. No, we don't have the quarterly numbers. Wow. No, what they have is an activist investing cheerleader. That's what they have. Unfreaking believable. See, you can't short them. Everything's too scary to short. Oh, Bank of America agrees with me already. The inflation party has started. That's exactly what's going on. It's a bit. At a certain point, you got to say, look, you got to just be bullish and bullish and bullish. Oh, Royal Caribbean gets approval for cruises to Cuba. I would like to go see Cuba. Fantastic. Oh, that'd be cool. I'm going to do that next year. Update. Used car pricing fell. Okay. Mexico updates on traffic. Who's going to Mexico? Capacity was pretty good. Traffic up 5% for Mexico. People fleeing this country, probably. Apple reportedly film studios. It's a terrible idea about the movie studios allowing their movies to be released, right? Who's going to go to the movies if they're going to release it 2 weeks later on Apple? Makes no sense. Lululemon. I thought they were finished. What a comeback. Where is that? That's a hell of a move. Somebody was just saying how they're screwed, and here they come while we're ripping back. Yeah, there you go. See? They were down here, and now they're zooming back up. Right, never listen to analysts. They're idiots. Comcast, blah, 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 blah. Wait, what did I say? Chicago Bridge and Iron upgraded. All right, that's one of ours. See, now, had we caught that earlier, that would have been my stock of the year, because I really love Chicago Bridge and Iron. How are they looking overall? I was banging the table on them a while back. Look at that. See, that's the problem. Is I was telling everyone this is great. It's too early for a stock of the year, but I would have picked that one. Fantastic. It was a really good price they were down to. Bayer buys stuff. Siemens. Double-digit digital business growth. Yeah, they say that, and people think it's like double-digit growth for the whole company. It's like, how do you know how much their digital business is? It's not that much out of the whole company. CBS is the top pick. Time Warner. Okay, so the Senate hearings on Time Warner and AT&T. It's going okay. AT&T's up 1.5%. Rio Tinto is upgraded. Rite Aid is an interesting pick. I don't think they're that interesting. I like Walgreens. My one I like. European shares are the widest discounts in the U.S. since 2009. They're way behind us, yeah. TransCanada, Japan casino bill. Oh, Japan might have casinos soon. That's going to be crazy. American Tower, Tesla battles. I don't think that's good for Las Vegas, though, on the whole. Tesla battles shareholders in Delaware court. Well, that's so they can have their own stores. Hooker Furniture, crude futures we did already. How's oil holding up? Oh, it's unbelievable. Oil, ooh, 49.88. So sorry. Doesn't matter though. Doesn't matter to the oil companies. Doesn't matter to anybody in the S&P. None of this matters. It's going up anyway. Wow. 19.5. We're almost there. 20,000 is right in sight, folks. 19.5. Holy cow. All right, let's see if they got the consumer spending numbers yet. Not yet. Is it 3 yet? Yeah, it's 3. I don't know how fast they put things up here. Go to Twitter. Not Twitter stock. My daughter. What were we talking about? Consumer credit, not spending. Latest. Increases slowest pace since June. Consumer credit, here we go. 21 billion forecast. What? That's a lot. Forecast 19. It's $2 billion over forecast on credit. Oh, wait. Oh, no, it's down. I'm sorry. Whoa. That's weird. Current release. Oh, it's October. It's not November. Consumer credit increased seasonally adjusted 5.14%. Revolving credit increased at 3%. Non-revolving increased at 6%. Then why are the numbers so low? Total percentage change. Okay, so I guess the thing is it's seasonally adjusted. You have to look at it like October to October. So it's not a bad number. It's just that October is usually down from the previous month. Total flow annual rate. Big variation though. Look at that. 230, 272, 329, 261, 192. Revolving credit way down. This is good though. This means the consumers are doing good. I mean, to me, if this is your outstanding revolving credit, although it's annualized, so it's hard to tell. But if this is your outstanding revolving credit, it's not that bad. New car loans. Okay, car loans looking steady. Well, this is the terms. Oh, these are the terms of credit. So the rates are steady on new car loans. Credit cards steady. Everything's steady. No real creep in the prices. Not a bad number. It's actually better than I expected. So unfortunately, there's nothing really here. There's no catalyst here to make the market more bearish. It's just honestly, until we get some bad news, I don't think we're going to go down. I mean, stunning as these moves are, there's nothing to stop them. So the default is going to be up and up. Yeah, I'm going to look more into that consumer credit and write something about it tomorrow, because that's an interesting number. But it seems like it is just a seasonal issue. So to sign the deal to sell capsules through Amazon. Oh, I see. That doesn't... How does that help them? Because they're widely distributed now. And it doesn't... To me, just like all you're doing is selling to Amazon for less money than you would ordinarily sell it to like a regular store. So it's like saying they signed with Walmart. Except Walmart does 10 times more business than Amazon does, and they're in Walmart. I see them all the time in Walmart. Not Walmart, Target. I don't go to Walmart. Yes, I am snobby. Okay, I don't go to Walmart. It's Target that I go to, but they're all over Target. I don't see that as it's not a big enough plus to make me love the company. But you know what? That's the kind of thing activist investors do to bump up the stock price. They make these deals that sound really good, but they're actually, it doesn't matter whether they are good or not. It just gives them, it bumps up the price, and then the activist investor takes their money off the table and they walk away and say, "Oh, I can't deal with these people. They're idiots." And that's it. And then they report that they sold. Anyway, thanks for getting that. That was good. So Cuba, please. The market's gone so much today we should put suicide on reviews. That's true. That is, that's why I go for all my negative news. I go to Zero Hedge. All right, got to wrap this up. 2 hours is a long time. So on the whole, we're stuck. I mean, we're stuck in a bullish market. Not that it's a terrible thing, but the way I play it is we keep adding look, whenever we make, how much, 133.9, let's see what we made since then. Oh, 133.5, we lost money. Oh my God, we lost 0.4%. How about the long-term portfolio? It was like at 134, right? Or, no, 130, okay, well, whatever. I've lost track now. But wherever it settles, it's a really volatile intraday number, so you can't tell. But wherever it settles out, the point is, when we make money in these portfolios, and I think Monday, perfect Tuesday, yeah, here it was, okay. So we were at 129.8, we had 229.8, right? And that was the options opportunity portfolio. So now we're at, where's my total? 233. So we made $3,500, let's say. So we made $3,500. Now I don't do it every day, of course. But the point is, at the end of a week or at the end of a month or whatever the cycle is, it doesn't matter. But I look back and I go, okay, so how much money did we make? How good do I feel about all these positions? But as a rule of thumb, I'll take about 1/3 of what we make, and we're only making this on paper anyway. I'll take 1/3 of what we make on paper, and I'll buy a hedge. And the hedge is exactly like we talked about there. It was selling, so what am I going to do with my hedge? I'm going to sell I'm going to be bullish first and collect cash by selling like those Gilead, the GILD puts, the $27 puts. So I'm going to collect the money from the puts. Now I'm going to buy myself another hedge. And in that example, we picked up TZAs, which is not very different than the TZAs we already have, except for a slightly squeezed. It was the 15.25 and not the 20.35. So we pick up the TZAs, and now I've got a very nice hedge, which pays like 5 times back on my money. So it's a 500% upside hedge. And all I've done is picked up, I've added a book, and to pay for it, I've taken $1,800 of my cash, of the $3,600 I made, and I'm going to buy a hedge. Now that hedge isn't necessarily going to go worthless, but that's my protection. And by doing that, though, I've now got myself $8,000 worth of protection against the $4,000 I gained. So I've got plenty of protection. That means I won't have to buy any more protection until I make, $16,000. I won't need any more protection until I'm way over again. And that's what we do. We keep layering on the protection, then we let the longs run, then when they run too far up, we take some of the money that we've made and we lock it in by buying more hedges. And that's it. It's a sort of like a leapfrog strategy, okay? Every time one gets ahead of the other, and then you catch up, and then you do the other. But at no time are you taking more than about a third of your long money and putting it into hedges. Because it's not up to the hedges to guarantee that you won't lose a penny. It's just to mitigate the damage on the way down. That's the primary use of the hedges. This guy's been disappointed. SJB, we knew we lost that one. But this junk, I can't believe that TLT has fallen off a cliff, but junk bonds are not showing any damage. That's just an amazing thing to me. I can't even explain how that's happening. Because clearly rates are ticking up and yet junk bonds stay the same. I don't get that. But we'll delve into that and other mysteries next week because I really got to sign off at this point. All right, well, thank you all for coming. It's been a lovely session, and we'll do it again next week. All right, take care, everybody.